Okay, let's unpack this. Imagine a company that's building the very plumbing for the AI revolution, literally the high-speed data highways of the future. But here's where it gets really interesting. Is this relatively small Canadian innovator on the cusp of becoming an industry titan, an indispensable piece of the next technological age, or will it burn out before its revolutionary vision takes hold? Just another promising tech story that couldn't quite cross the finish line. That's the core, almost binary question we're diving into today.
Absolutely. Today, we're not just dissecting a stock ticker, POET. We're exploring really a fascinating case study in high-stakes innovation. It's a deep dive into an exciting, potentially transformative technology with, well, immense upside, but also, substantial, very clear risks. What truly stands out here is the stark contrast between a brilliant, innovative solution and the challenging, almost pre-commercial financial reality.
Welcome back to the deep dive. You've asked us to take a close look at POAT Technologies, Inc., NASDAQ ticker, PO8. We've got a detailed report, our deep stock research protocol, acting as our guide for this exploration, our mission. To distill the key insights, maybe some surprising facts, and help you understand what's truly important about this company. This is based on our analysis date, August 25, 2025, when its share price was sitting at $5.36. To really understand what POAT Technologies is all about, we have to start with the basics, right? The foundational question. What exactly do they do? Could they truly be an unsung hero in the AI hardware revolution? Let's jump into Chapter 1, Business Analysis, the AI hardware revolution's unsung hero.
Okay. What's fascinating here is their core innovation, something called the POET Optical Interposer. Think about it like this. Imagine building intricate computer chips by hand. That's essentially what high-performance photonics assembly has been like. Complex, expensive, slow. POET's big idea, what they call the semiconductorization of photonics, is to automate that, to bring the efficiency of wafer-level manufacturing, just like we see with traditional silicon chips, to these optical components. It's a potential massive shift from, crafting individual pieces to mass production.
And their business model is interesting too. It's hybrid, not just product sales, but also licensing out the intellectual property for this platform.
Okay, so they're semiconductorizing photonics. That sounds impressive. But what actual products are they bringing to market? What are they selling right now or trying to sell? Well, their main offerings are optical engines. These are the critical components that convert electrical data into light and then back again. They act like high-speed translators inside data centers and networks. These include products like the POET Teralight for massive 1.6 terabit per second applications. That's huge data rates. Then there's the POET Wavelight for 800 gigabit per second needs, and POET 1 for 100G connections. They also develop specific light sources needed for these engines, like POET Starlight and POET Lightbar, and they offer custom photonic solutions too. But everything is built upon that foundational optical interposer platform.
And beyond the physical products, you mentioned IP, they have this formidable patent portfolio, 214 documents strong, which they can license out. That sounds like a significant asset, maybe a real intellectual property moat, right?
It absolutely is, or at least it could be. In a technology arms race like this, a strong patent portfolio can be a major differentiator and potentially a source of future revenue streams. It's a key part of their value proposition.
Okay, so they've got compelling tech and some IP protection. But let's zoom out for a second. With a market cap of around $460 million, POET is, let's face it, a microcap innovator. They're playing in a world of giants like NVIDIA, valued at over $4.3 trillion. That's like comparing, a really promising local garage band to a global superstar stadium act. What gives them a fighting chance against such, well, overwhelming competition?
It comes down to their value proposition, which is genuinely multifaceted. It's about solving fundamental problems in photonics assembly and performance. The optical interposer promises significantly lower cost, dramatically lower power consumption, miniaturization making things smaller, and crucially, scalability to incredibly high volumes. It's not just an incremental improvement. The idea is it replaces complex, manual, expensive assembly with automated semiconductor manufacturing processes. For AI data centers, which are consuming unprecedented amounts of energy and demanding ever faster data throughput, this could be a genuine game changer if it works as advertised and scales.
Right. So it's about addressing that core bottleneck in scaling photonics for the just exponential demand of AI. If they succeed, they're not just making something a bit better. They're potentially enabling the next generation of AI infrastructure. That's a huge addressable market then.
Enormous.
Yeah.
Absolutely massive. They're operating in a market that's expected to grow from, $984 billion to over $1.6 trillion by 2032. And that growth is primarily driven by AI, cloud computing, 5G, all the big trends.
Mm.
However, as you alluded to, the competitive landscape is fierce, really fierce. We're talking about giants like Intel with their own optical compute interconnect or OCI chiplet technology. There's Broadcom. NVIDIA itself is involved in networking. Then you have specialized competitors like Applied Optoelectronics, ticker AAOI, and a whole host of emerging startups trying similar things. This raises that critical question for investors. Can a smaller innovator like POET actually carve out a niche against such formidable players? Or, even disrupt them?
And the barriers to entry are just incredibly high. In this space, we're talking billions needed for R&D, extreme technical complexity, and these entrenched IP moats held by the big guys. So if POET can actually get a foothold and scale up production, they might find themselves with a very strong, defensible competitive advantage.
Exactly. Their primary unique asset is that patented optical interposer platform itself. It's a novel manufacturing methodology allowing what they call hybrid integration, putting different materials like lasers and detectors onto a single silicon interposer efficiently. This mix and match capability, done in a scalable, automated way, is their core differentiator. Plus, those strategic partnerships they've announced with major industry players like Foxconn, Luxshare Tech, and Mitsubishi Electric provide significant industry validation. It suggests their tech isn't just lab work. Big players see potential.
Okay, so the tech seems promising, there's validation from partners, and a potential cost and power advantage if they can scale. Fascinating stuff. Now, let's pivot a bit to the human element. Who's actually leading this venture? Who's steering the ship? And what kind of track record do they bring to this pretty high-stakes vision? This brings us neatly to Chapter 2, Management Evaluation, Stewards of a High-Stakes Vision.
Right. The company is led by Dr. Suresh Venkatesan. He's been CEO since 2015. He's a technologist at heart, with over 2 decades in the semiconductor industry at major firms, think Freescale, Global Foundries. His deep technical expertise is absolutely central to the company's vision, and frankly, it's vital in a deep tech company like this. You need someone who understands the nuts and bolts. The leadership team also shows decent stability, with an average tenure of around 6.2 years.
Okay, 6.2 years average tenure. That suggests a cohesive team, which is usually pretty crucial for long-term R&D efforts like this. But running a pre-revenue, high-tech company for, almost a decade now, that must come with some serious challenges. What kind of fires has this team had to put out? What have been their biggest tests so far?
Well, navigating that valley of death and the period before significant revenue comes in is incredibly tough, and that has been their biggest ongoing crisis, if you want to call it that. They've had to repeatedly access capital markets to fund operations. That's just the reality, which has, of course, meant shareholder dilution over time. But, it's been crucial for the company's very survival to keep the lights on and the R&D going. A key strategic success, though, which I think demonstrates significant foresight, was acquiring their Chinese joint venture, SPX, and then proactively shifting manufacturing focus to Malaysia. This was a clear move to mitigate geopolitical risks before they became potentially crippling.
That's a good point about foresight. Does it truly insulate them from geopolitical risks entirely, though? Or does it just kind of shift the nature of those risks? And what's been the cost of that strategy? I mean, presumably more dilution for existing shareholders to fund that shift.
That's a very valid concern. No company, especially in semiconductors, is entirely insulated from global forces. The move to Malaysia mitigates some direct China-centric risks, yes, but the global semiconductor supply chain remains incredibly interconnected, so they're still exposed to other potential disruptions. And yes, every capital raise, every strategic move like that generally comes at the cost of dilution. That's the trade-off. Their transparency seems pretty good, though. They issue frequent press releases, lots of SEC filings, which allows investors, you as a listener, to track these developments closely.
Okay, given they're entirely in this high-growth, high-investment phase, how are they actually allocating the capital they raise? Where is the money going?
Their strategy is all about investing for future growth. There's really no other way for them right now. A substantial portion of their capital goes directly into R&D. We saw $3.4 million in Q4 2024 alone, which is significant for their size. And critically, it goes to scaling up those wafer-level manufacturing capabilities in Malaysia. That's the bottleneck they need to overcome. Their M&A strategy, when they've done it, has been highly targeted, like acquiring Genslate for specific manufacturing capabilities and SPX for crucial IP control and that geopolitical shift. Importantly, there's absolutely no history of share buybacks or dividends. Every available dollar gets plowed right back into the business. That's classic growth company behavior.
So definitely don't expect a dividend check anytime soon. This is a pure play on future growth. Speaking of returns, or lack thereof currently, what about their return on invested capital, or ROIC?
Well, their ROIC is deeply negative. It stood at negative 45.39% for Q2 2025. Now, for your investment, it's important to understand this isn't necessarily a red flag in itself for a company at this specific stage. It simply reflects very heavy investment before any significant profitability. But a negative 45% ROIC, that really takes some serious conviction from investors, doesn't it? It really underscores that this is a bet on the future, not current performance. It's almost like a venture capital gamble playing out in the public markets. The critical question for you as a listener is whether these substantial investments will eventually yield very high and sustainable returns down the road.
Okay, we've explored the tech and the team leading the charge, but as any investor knows, the real test often comes down to the numbers on the page. So let's peel back the layers and get into the nitty-gritty of POAT's financials. This is Chapter 3, Financial Analysis, a deep dive into the numbers. And just a reminder, we're looking at a small-cap company, around $484.4 million market cap as of our analysis date. What do the numbers truly tell us?
Okay, here's a truly striking fact. Despite all the advanced tech and those strategic partnerships we talked about, POAT's total revenue for all of 2024 was just $41,000. Let me repeat that, $41,000. Their latest trailing 12-month revenue, as of June 2025, was a bit better, approximately $468,000. But this isn't just low. It's a stark reminder that this company is essentially pre-commercial. They are living entirely on future potential right now. And consequently, profit margins are, well, profoundly negative. An operating margin of negative 10,036% and a net profit margin of negative 11,497% for Q2 2025. These numbers just scream heavy investment phase. They are incredibly far from generating profits.
Wow, those numbers are stark. They really paint a picture of a company burning through cash very quickly. So what about their cash flow? Are they just hemorrhaging money?
Yes, essentially. Free cash flow has been consistently and significantly negative over the past 5 years. This indicates a high cash burn rate, which is necessary, you could argue, for the R&D and the manufacturing expansion they need to do. There was a recent positive free cash flow reported in Q2 2025, but that was an anomaly. It was driven entirely by financing activities, in other words, raising more capital through equity, not from sustainable business operations.
Okay, so their cash flow just confirms they're reliant on external funding. How stable are they financially, given these figures? I mean, are they close to running out of money, or do they have a solid runway from their latest capital raise?
Well, they maintain a low debt-to-equity ratio, around 0.132. Normally, that would signal financial conservatism, right? Low debt is good. However, for POET, this isn't because they have strong earnings covering their assets. It's a direct result of funding operations almost exclusively through issuing new equity, new shares. Their current ratio, which measures short-term liquidity, is 1.89. That's generally considered healthy. But again, this apparent stability comes from the cash they've raised through equity financing, not from operating profits generated by the business.
Right, so their financial stability hinges heavily, almost entirely, on their ability to keep tapping the equity markets, to keep raising capital, not on generating it themselves yet. That's a critical distinction for your investment decision, isn't it? How does this impact the traditional valuation metrics we look at?
Exactly. Given their negative earnings, the price-to-earnings, or PE ratio, is completely meaningless. You can't divide by zero or a negative number here. Their price-to-sales, or PS, ratio is extraordinarily high, over 978 based on that trailing 12-month revenue. And their price-to-book, or PB ratio, is also quite high at 9.89. These multiples clearly indicate the market isn't valuing them on current performance at all. It's placing a massive premium on enormous, assumed future growth potential.
Okay, so standard multiples are basically off the charts. What about trying to estimate an intrinsic valuation, like using a discounted cash flow or DCF model? Can that shed any light on what they could potentially be worth if things go right?
Well, for a pre-revenue company like POET, running a DCF model is highly speculative. You're making assumptions about revenue that doesn't exist yet. We looked at one educational model, just for illustration. It calculated a potential intrinsic value of $11.47 per share. But this relies on exceptionally aggressive assumptions. You need high, multi-stage revenue growth for many years, hitting very specific targets. And you also need to use a very high discount rate in the model to account for the immense risks involved. It's so important for listeners to remember, these are models, they're not predictions or guarantees. They just highlight potential under very specific, optimistic scenarios. And the margin for error is massive.
That's a crucial caveat. Very important context. Okay, so we've looked at the technology, the team, and the frankly, challenging raw numbers. Now, let's turn our attention to the broader market and investor sentiment. How is Wall Street actually perceiving Pewit Technologies? What are the analysts saying? Let's get into Chapter 4, Market Sentiment. What is Wall Street saying?
Okay. If you look at the professional analysts covering the stock, they're overwhelmingly bullish. The consensus rating is a strong buy. The average 12-month price target from the three analysts providing them is $6.63. Compared to the current $5.36 share price we noted, that suggests a potential 24% upside over the next year, according to them. Firms like Craig-Hallum and Northland Capital Markets are known to be covering it.
Okay, on the surface, the strong buy consensus sounds fantastic, very positive. But for a company like Pewit, does Wall Street's enthusiasm always align with the, day-to-day realities and challenges? Or are there times the market gets cold feet? What's the pulse beyond just those analyst ratings?
You've hit on a key point there. The market perception for POET seems very event-driven. It's almost binary in its reactions. Positive news, like winning AI hardware innovation awards or announcing new strategic partnerships, tends to fuel rallies in the stock price. People get excited about the tech. However, announcements of public offerings raising more money through selling shares, even if it's absolutely necessary for survival and future growth, are often met with immediate selling pressure. Investors worry about shareholder dilution, about their stake getting smaller. We've seen headlines, for example, like Pewit Technologies stock drops on heavily discounted $25 million offering. So it seems the market loves the story and the tech, but maybe not the financial realities of funding it.
Yeah, a bit of a tug-of-war there between the dream and the dilution. What about other market indicators, things like short interest, moving averages? What do they tell us about the current technical picture for the stock?
Well, short interest is currently around 6.78% of the float. That's not extremely high, but it's notable. And importantly, it's been on an upward trend recently. For your perspective, this indicates a growing number of market participants are betting against the stock, expecting its price to fall. They're shorting it. Technically, looking at the charts, the stock is trading significantly below both its 50-day moving average, which was $6.93, and its 200-day moving average, around $5.69. Both of those are generally considered bearish technical signals. They suggest negative price momentum in the short to medium term. So you have this interesting contrast. Analysts are bullish long-term, but some traders and technical indicators are showing near-term headwinds.
A really interesting contrast indeed. Okay, let's peek behind the curtain a bit more. Who actually owns shares in Pewit? Is it big institutional players, the Vanguards and BlackRocks of the world? Or is it more individual investors, maybe specialized funds? This is Chapter 5, Ownership Structure. Who owns Pewit?
Right. The ownership structure is pretty consistent with what you'd expect for an early-stage, high-growth, maybe high-risk tech company.
Wow.
We're not seeing the typical blue-chip asset managers holding large positions here, which isn't unusual at this stage. The largest institutional holder identified is MMCEP International Inc., SBC. They significantly increased their position recently, holding over 5.8 million shares, and there seems to be a dynamic trend overall. More institutions have been increasing their positions lately than decreasing them. This suggests some specialized funds are actively building positions, making a bet here.
Okay, specialized funds getting involved. What about the insiders? How much skin in the game does the leadership team itself have? Does the management team seem to believe the stock is undervalued at these levels? Are they buying?
Insider ownership is actually relatively modest. The CEO, Dr. Suresh Venkatesan, owns about 0.3% of the outstanding shares. What's perhaps more interesting, or telling, is that there have been no open market purchases by insiders reported in the last 12 months. There were some sales reported, though details might vary. Now, this doesn't necessarily signal a lack of confidence in the company's long-term future. People sell shares for many reasons. But it also doesn't signal strong conviction from the inside that the stock is significantly undervalued at current prices. That lack of buying might be a point of consideration for your analysis.
Okay, so no single dominant shareholder, but an increasing bet by some specialized funds. Yet the insiders aren't exactly loading up on shares themselves. It adds another layer to the complex story. Now, every investment carries risk, and for a company like Pewit, those risks can be substantial, maybe even existential. Let's try to break them down systematically with a SWOT analysis: strengths, weaknesses, opportunities, threats. This is Chapter 6, Risk Assessment, Navigating the Headwinds.
Absolutely. Let's start with the strengths. As we've discussed, you have their proprietary, patented optical interposer technology. That's the core. This presents a clear, potentially compelling value proposition. Lower cost, lower power, scalability. They've experienced technical leadership under Dr. Venkatesan, and they've achieved strong industry validation through those key partnerships with big names. But the weaknesses are equally stark, and you have to weigh them carefully. There's the long history of significant net losses, the high cash burn rate we talked about, a fundamental lack of commercial scale so far, persistent shareholder dilution from financing rounds, and frankly, very high execution risk in actually scaling up that novel manufacturing process in Malaysia. It's not proven at volume yet.
Those weaknesses are definitely a significant cause for concern, very real hurdles. Looking forward, where do the big opportunities lie for POET? And conversely, what are the biggest threats that could potentially derail this promising technology before it takes off?
Okay, opportunities. The potential is huge, driven by that massive market growth in AI and data centers. There's the potential for their optical interposer to become an industry standard, which would be absolutely transformative. Think Intel Inside, but for optical engines. There's also the possibility of being an attractive acquisition target for a larger tech giant looking to quickly gain this capability. And they could potentially expand into new applications beyond data centers, like telecommunications networks or even automotive LiDAR sensors down the road. However, the threats are equally formidable. Intense competition, especially from giants like Intel with their own OCI technology. They have immense resources. There's the ever-present risk of technological obsolescence. What if someone develops something even better, faster? This field moves quickly. There's a risk of customer concentration, especially early on. If their initial success relies too heavily on just one or two big players, losing one could be devastating. And then there are those significant macroeconomic and geopolitical factors we touched on earlier.
Yeah, can you elaborate a bit more on those macro threats? Because these are factors largely outside of POET's direct control, but they can dramatically impact a company, especially one in this fragile stage.
Certainly. Take interest rates. A high interest rate environment directly increases POET's cost of capital. It makes borrowing money more expensive, if they even could borrow. It also generally dampens investor appetite for high-risk, non-profitable growth stocks like POET would. Money flows to safer assets. Persistent inflation also directly raises their costs for materials, for equipment, for skilled labor, which would just exacerbate their already high cash burn. On the geopolitical front, even with the move to Malaysia, the global semiconductor supply chain is deeply interconnected and complex. Disruptions from trade tensions, new export controls, or tariffs like those U.S.-imposed tariffs back in 2025 can lead to delays, increase costs, and could even restrict their access to certain markets or critical components. It's a really complex, challenging global backdrop for any company right now, let alone a pre-revenue innovator trying to scale a brand new technology.
A lot to consider there on the risk front. Definitely not for the faint of heart. All right, we've done the deep dive. We've meticulously examined the technology, the team, the financials, the market sentiment, the ownership structure, and all those inherent risks. Now, let's try to bring it all together. What's the bottom line here for POET Technologies? This is our final chapter, Chapter 7, Conclusion. Synthesizing the bull and bear cases.
Okay, the bull case is, you have to admit, compelling. It's built on the premise that POET possesses a truly game-changing optical interposer platform, one that solves fundamental problems in photonics assembly and performance problems that are becoming critical bottlenecks for the future of AI. If management executes successfully on scaling up manufacturing in Malaysia, and if they can convert those strategic partnerships into high-volume commercial revenue streams, then POET could become an indispensable component supplier for AI data communication. In that scenario, their current valuation, sub $500 million, would seem minuscule in hindsight. They could effectively become the Intel Inside for the optical engines powering the next wave of the AI revolution. That's the dream.
That's the dream scenario, right? The what if everything goes perfectly outcome. What's the reality check? What's the cold water, the bear case that investors absolutely need to understand and weigh?
The bear case is grounded firmly in that harsh financial reality we just discussed. POA is still essentially a pre-revenue venture. It has a high cash burn rate and has consistently diluted shareholders just to stay afloat and fund development. The path to profitability is long and fraught with peril. There's immense execution risk involved in scaling a novel manufacturing process that hasn't been proven at mass volume. There's that long history of losses and still unproven commercial viability at scale. Can they actually sell this stuff profitably in large quantities? And critically, those industry giants like Intel, with their vast resources and existing market relationships, pose an existential threat. What if they develop competing solutions faster or more effectively? The bearish outcome is that PO8 simply runs out of capital, or maybe investor patience runs out, before its revolutionary vision is fully realized and profitable. In that case, the equity could become worthless.
So where does that leave us on valuation, given this dramatic, almost night and day difference between the potential bull case and the very real bear case?
Well, the current market price, that $5.36 we noted, clearly reflects future potential far more than it reflects current fundamentals. The fundamentals just aren't there yet. Analyst targets average $6.63, suggesting some near-term upside if you believe them. And that speculative DCF model threw out a number like $11.47 per share under very aggressive assumptions. But again, these are based on assumptions about future success that are far from guaranteed. For your investment, it's absolutely crucial to understand these are models and targets, not predictions. They're built on a future that hasn't yet materialized and might not.
So what does this all mean for you, the listener, if you're considering this company? How do we encapsulate this whole deep dive for someone looking at POET technologies today?
I think the key takeaway is that this is truly a near binary investment outcome. It's likely going to be a huge success or a near total failure. There might not be much middle ground. POET is not a traditional Buffett-style investment, buying a wonderful company at a fair price based on current earnings and stability. It just isn't. It's effectively a venture-stage enterprise that happens to be trading in the public markets. An investment today is an explicit bet on that bull case unfolding. It's a bet that the technology is commercially superior and that management can successfully navigate that treacherous chasm between a groundbreaking idea and a profitable scaled business. The risks are substantial, they are multifaceted, and they absolutely cannot be understated. You're effectively buying into a vision, a story, a potential future, not current performance.
Okay, a clear binary bet. Here's something maybe to mull over as we wrap up. If POET's semiconductorization of photonics truly is a disruptive innovation, could its greatest threat actually not be direct competition from Intel or others? Could it be the sheer speed at which AI technology itself is evolving? What if AI demands even more radical, completely different solutions before POET can fully scale and embed itself into the current generation of infrastructure? What new plumbing might be needed next? And could POET, or anyone, keep up with that pace? Just a thought.
That's a fascinating question. It really highlights the high-stakes, high-reward, fast-moving nature of innovation in this AI era. This deep dive into POET technologies truly showcases that dynamic. Thank you for joining us on this insightful journey today.
And thank you for listening. If you found this deep dive valuable, please like and subscribe to the Stock Analytics AI YouTube channel. Remember, members paying just €4.99 a month get priority requests for deep dives on tickers like this one. Over the next few months, we're planning on covering all of the S&P 500 stocks, and members get exclusive priority access to those analyses. If you just want a one-off deep dive on a specific stock, you can always drop us a super thanks on YouTube.
And just the important reminder, this analysis was generated by an AI system. It is intended for educational and informational purposes only and should absolutely not be considered financial advice. Please always conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions. Until next time, keep digging, keep learning, and stay informed.